Those
Scott.
that can leave.
Right, yeah, I think I told you I went to Texas 4 times in 2025, and Dallas 3 times and Houston once, and some of them were in the summer. And oh boy, do I understand a little bit more
Yeah,
what
yeah,
what the thought process
exactly. I
is
mean, you
there.
feel like you're in
Yeah,
a convection oven. You got the heat and it's wind spinning around you, and you're just like, this is terrible. I used to do M&A, if you remember, in early
yeah,
years, and I was in California a lot, northern, of course, up in Silicon
right.
Valley, and I would spend all week there. Then I'd come back for the weekend, and I'm just like, why am I even coming back? Like, this is, you step off the plane and you just start sweating. Like, this is terrible.
It is something. It is something. Paul, great to see you. Sam, Scott, delighted to see you here today. We're going to get going here in just a minute. Just make sure to let everybody in here. But really great to see you. You all are in for a treat. Um, I'm going to I think we are live streaming. We'll get our presentation up here going. All right. Hopefully you all can see that. Fantastic. All right. It's always, I wish I had kind of octopus arms for the number of things that need to happen to live stream, get up the presentation. No, this is good though. Scott, I hope things are going well in San Diego. Scott works at with the San Diego Zoo. It's always so
Oh wow,
exciting to
that's
hear what
fun.
he's up to. Oh yeah, just incredibly impressive. Todd, great to see you, friend. Hopefully you got my text this morning. Wonderful to see you. We're going to get going here in just a second. Arib, nice to see you. Thanks for joining
Yeah,
us.
San Diego's beautiful. I remember it was
Oh,
funny back when I was doing M&A, we were looking at a company, and this was kind of wintertime, looking at two companies. One was in Detroit and one was in La Jolla. Which one do you think the numbers looked a lot better on La Jolla?
yeah.
Because I would be the one having to go there every week, and I'm thinking, my
Oh,
pictures, Detroit in my mind is like brown snow, and like
yeah.
no,
Tough choice. Tough choice. My mom's from Detroit, by the way, of Compton. Believe it or not,
whoops.
I know we haven't gotten her straight out of Compton t-shirt yet, but maybe one day soon. But yeah, we went to Detroit for the first time last year since she left when she was young. It was quite an experience.
Hmm.
Bob, nice to see you. Mark Berger, hi friends. We're going to kick this off here. I'm going to hit record for the folks that aren't able to attend. Tim King, everyone, welcome. We're really excited to have you here today. It is no secret that 2026, the macroeconomic landscape is changing and ever evolving. And our job and what we're excited to do is really talk you through some of the data that we're looking at. And obviously, we've got an incredible person here, Mr. Bruce Frazier with Elkhorn Capital Partners, who's joining us. And for those who don't know me, my name is Amy Silvis. I'm the founder and CEO of Silvis Capital. We connect investors to hands-off real estate investment opportunities. We now have 20 apartment complexes and flex industrial, 5 of which are actually partnerships with Bruce and Elkhorn Capital Partners in Oklahoma City and Tulsa. For those who don't know Bruce, he is a former hedge fund manager, excuse me. After trading at all-time highs during the 2008 and 2009 financial crisis, he directed his attention to building a portfolio of hard assets. He has been a full-time entrepreneur and investor fiduciary since 2000, overseeing the management of over 2 billion in investor assets, and he's overseen over 100 real estate transactions for partners. His accolades are phenomenal, but his track record is also incredibly impressive, which is why we're excited to have him here today to join us and talk through a bit of what we're seeing in the macroeconomic environment. Bruce, we're really excited to have you here today. Thank you again.
Great to be here. Great to be here. It's my whole team. We talk about macro environment a lot, trying to figure out where things are headed. So we try to get on the right side of it. We've been very
Mhm.
successful at doing that in the past, and hopefully we get it right this time too. Looking forward.
Well, I would love, for those who don't follow you on LinkedIn, I'm actually going to put that link in the chat. But
Good.
you have such a great handle on this macroeconomic environment when, we're looking at tariffs, we're looking at the national debt, interest rates, a new Fed chair. There are so many moving parts. And I'd love to just kick this off from kind of a top-down approach because all of us here are investors as well, but we can't invest outside of the macroeconomic context. So it'd be great to kind of understand what you're thinking through in terms of the headlines or what you're seeing here in 2026.
Well, you cannot invest outside of it. You'll just lose money.
Yeah, not successfully. Thank you. Correct.
Most people don't pay attention to the most important thing, which I think is the macro. And I had that discussion with some investors at a real estate conference probably, gosh, I don't know, maybe 7-10 years ago, and everybody's talking about where we were in the real estate cycle at the time. They're all like, "Oh, we're late stage," and I'm like, honestly, where we are in the real estate cycle at that point in time, I said it probably doesn't even matter. What matters is what's going on with the currency and the debasement of the currency. So, there's we subsequently, I look back at that, and we made millions of dollars after that in real estate, when there's so many people on the sidelines because we thought we were late stage. But yeah, anyway, so headlines, gosh, so complicated of an outlook right now. It's very, very uncertain. We've got a new administration making moves that weren't on your bingo card the day before. Like, they're making very large changes and doing things that you didn't think was kind of an option. And so, Venezuela is a great example. Politically, I'm not going to touch that, but strategically, very smart to do. It's, they've got they're one of the most resource rich countries in the world. And if you look back pre-Vietnam, wars were about resources. You would take over countries to take their stuff. And then we got in this PC world where we fight wars for other people and go into massive debt, and we don't take their stuff. And so we end up, insolvent. Venezuela was not about narcos. I mean, that's just kind of a headline and, a bonus. If you were really going after the narcos, you'd go into Colombia, right? Or Mexico.
Right.
But it gives cover, and now we control one of the world's largest reserves of oil, and another, not to be political, but because it rubs some people the wrong way, but it's smart. We depleted our strategic petroleum reserve to try to, under the Biden administration, trying to reduce oil prices, which makes sense if you're trying to fight inflation because oil is one of the number one inputs to it.
Right.
But they never replenished it when it went below 70, like they said they were going to. And so left us in a militarily strategic bad position. And Trump just said, hey, first thing we're doing, we're going to refill the SPR and we're not paying for it. Guess what? It's like, okay. Smart, but
yeah,
not usually something you say openly, so things are unpredictable for sure. But there are some things that are pretty clear. You and I talk a lot about the U.S. government debt, what's going on. And it's honestly not just the U.S. It is basically the entire fiat system, which, on the whole world stage. But, we are math people, we are quants, and we try to think through everything based on the numbers and what it's telling us. We try not to be emotional about it. But if you look at the numbers, the debt can't be repaid, not in today's value dollars. And so it's just not possible. They could do wealth taxes or whatever else they could dream up. Yep, there you go. Look at the rate of change of that graph. It's hard to even put up anywhere now. It's just so crazy.
It's hard to digest.
But that is the annual U.S. government debt, and it's growing at over 10% a year on a big, big number. The kind of the rules of math are that as the number gets bigger, usually the growth rate slows because the incremental is a lower percent of the overall, but that's not what's happening. It's actually spiraling now, and it appears to be growing faster and faster, and so that's a problem because you have to have buyers for all that debt, and so who's big enough to buy it? Well, central banks. They're really the only ones that matter. And we stepped on kind of a bit of a landmine where it seemed like the right thing to do, I guess, if you didn't think through it fully. But in February of 2022, the U.S. did what, quote, sanctions on Russia. We didn't want to get into a hot war with them, so we did something financial to them. And for those that don't know, central banks, of course, they keep reserves of currency, and that's usually, it's not actually in stacks of cash, it's in the treasuries or debt securities of the associated country. And so prior to World War II, central banks on average kept 80 to 90% of their reserves in gold. And during World War or just after World War II, the U.S. was kind of the biggest, baddest on the block. We just saved the world. We also had 2/3 of the physical precious metals holdings in the world, and so it made sense to make the U.S. dollar the formative base of the monetary system that was being reformed. And so it became the world reserve currency. People started using it for the reserves. After 71, we went off the gold standard and things kind of went to shit after that. Excuse my language. But so there was no constraint at that point on how much we spent because people had to use our dollars and in world trade at that point. So fast forward to today, the percent that people or central banks kept in gold got down to right at 10%. And the rest was in dollars and other things, but mainly dollars. And so 2022, we basically just, they say froze, but we took Russia's reserves, and depending where you source your numbers, that's anywhere just under 400 billion to a trillion, depending which accounts you include in it. But a lot of money, and it was a line that had never been crossed before in the world. And when that line was crossed, people thought there wasn't any counterparty risk, and all of a sudden they woke up and said, "Gosh, our entire net worth of our country has major counterparty risk to the political whims of this other country." If you're Brazil or Chile or France or Germany, you look at Russia and you say, you know what? They're one of the big boys on the block. They've got hypersonics. The US doesn't even have hypersonics yet. They've got nukes, and they just stole 400 to a trillion dollars, 400 billion to $1 trillion of theirs. What will they do to me? And so, so everybody all of a sudden felt that risk. And so the obvious outcome of that was, what did they start doing? They started becoming net sellers of treasuries and adding gold. And so that's why there's just this continuous bid for gold right now, no matter where the price is, because if you're running a central bank, you tell your team, you say, we're at 10%, take it to X percent, whatever that is, 60%. Are we going to go back to 90? I don't know, but it's something higher than 25 to 30 where we are now. And so, we've gone from 10% to 25 to 30% in a very short order. And so, the central bank buying has moved from what was roughly 17 metric tons to, they forecast, I think it's 76 metric tons today. And so complete paradigm shift. And I don't think you can put that genie back in the bottle. And so you can't say, oh, no, we won't do it to anybody else. Nobody, you've breached the trust of the world. And so that's a trend that's going to continue. And so what does that mean for us as investors though, right? And so, well, that means fewer buyers of the debt, more debt needing to be issued. Somebody's got to buy it. And, your biggest buyers that matter aren't buying it. And so that means that the nice term for it's quantitative easing, but what it means is we print our own money, not physically anymore, but electronically. We create new money out of the air to buy the debt securities ourselves. And they just restarted this in January, 40 billion. And they said to anticipate that level per month going forward for the foreseeable future. Well, I promise you the number is going to get higher. But that's kind of where things are right now. So I've talked a lot. I'll let you go. But
no, this is fantastic. Go ahead.
But the graph that you just put out, it's a graph that I created just to kind of monitor the growth rate, and you can see we hit the debt ceiling at least once a year. The debt ceiling was originally created to be a constraint on spending. It wasn't put in place to create a political negotiating lever every year, just to raise it again. And so, there's always this hand reading every year, and it's probably going to be more frequent than every year now with things increasing. But all this hand reading over whether they're going to increase the debt ceiling and what's going to happen. Of course, they're going to increase the debt ceiling because otherwise we default. And so, they've done it, I think, close to 100 times now over history. And so we hit the debt ceiling. But when you hear that, the funny thing is, it doesn't mean that they stop spending the money. They just stop paying bills, right? They just stop paying bills for a period of time. And so then when the debt ceilings increase, there are all these stacks of bills that have to be paid. And so, the debt spikes up again immediately. And so, it doesn't level off. If you see, what was that back in 22, when we hit the debt ceiling, flat for a period of time while, politicians were trying to negotiate with each other and get a bunch of, bridges to nowhere tucked into the spending bill. And then it goes up, but it doesn't ever level off. It just keeps going up until it hits the next debt ceiling that was reset. And we're in a period now where that's happening again. But that is you look at more recent history further back than this, we were averaging a growth rate, like I said, just over 10%. But on the most recent period on that post-debt ceiling graph, it's closer to 15% annualized. 15% on $38 trillion is a big number. And, we're adding $1 trillion in debt roughly every 90 days. And that's with current spending levels. And so $1 trillion is hard to even conceive how much that is. I won't go into it here, but Google how that differs from $1 billion. It's shocking how different it is from $1 billion. It's more debt than anybody's ever had in the world. And so, how do they solve it? And you and I have talked about this a lot, but there are a few ways you can solve it. In theory, you could raise taxes, which is always the popular thing for people to talk about. And what politicians often forget, and we're seeing it, we've seen this happen over and over, but in your home state of California, they're proposing, they haven't even put it in yet, but a wealth tax. Well, you know what? Money is fungible and transportable now. So what ended up happening? All the famous billionaires that moved their entities to either Florida or Texas for legal status to try to get out of the way. Well, now they said it's going to be retroactive, but you know what? They're like, you've shown your stripes. It's kind of like us doing the sanctions. Like, if you're thinking about it now, it's going to probably happen at some point. So I'm out, and I'm going to take my toys and go to a different sandbox. But if you do the math on it, raising taxes can't solve the debt problem. It couldn't even solve our current 1-year deficit problem. And so that's not a solution. Cutting expenses, Doge, a lot of people were really optimistic about it. They had all these geniuses trying to solve this, just quagmire of, waste and fraud. And, there was so much pushback against it. And I've heard Musk interviewed about it. He's like, listen, we won't name names, but he said 90% of the fraud is on one side of the aisle, but there's still about 10% on the other side of the aisle. And so there's not enough support to get any of these cuts approved. And so he just kind of washed his hands of it and left, and he was really excited about trying to help the country. And, on a Rogan interview with him, he's like, well, how much do you think you could have cut? And he said, well, what kind of powers do I have? And, they're video game guys. And he's like, godlike powers. And he said, oh gosh, with godlike powers, I could cut more than half of the spending. But it wouldn't politically, there's so much grift that they don't want those programs cut. So that, I'm not optimistic about expenses solving the problem. Default, they're not going to explicitly default. Every time in history we've ever looked, they have the choice of saving the currency or protecting the debt, because the debt allows for all the spending. They always sacrifice the currency, always, every time. And so, they're not going to explicitly default. They'll just pick the fourth option, which is inflation. And so they'll print money. There'll be high and sustained inflation. They'll continue to change the CPI calculations so it's not fully reflected. But you and I, as consumers, will be spending a lot more than a 3% increase on inflation. Even at 3%, people are like, oh, inflation's gone down. Well, the rate of growth of inflation has declined in theory. Part of that is them changing the calculation again a couple of years ago. But if it went up 100% and then went up another 3%, well, you know what? You don't feel any better. It's still worse. And so, a couple of years ago when CPI printed 9%, the funny thing is, if you kind of look under the hood, how is that comprised? Well, right at a third of it is tied to what they call owner's equivalent rent, which is just a Frankenstein number that they've changed over the years to try to represent what housing costs is without showing much inflation. But CPI, which is a third of it, was showing a 3% increase. And this was a period of time where housing prices had doubled, and rents had certainly gone up, you and I both know, and double digits. And so, it's just absurd, absurdly wrong number. But even 9%, people were getting really upset, even though because they felt like it was even more. But so the game here is to have high and sustained inflation and not show it, and try to keep it probably mid to upper single digits. So the peasants don't riot, and get angry. But this is the fifth one, is one that was, really not on my list previously. And that's to grow your way out of debt. And so Bessent, head of the Treasury, very smart guy.
Yes.
When they saw Doge kind of fail, like, okay, well, the only other choice is to grow GDP faster than we're growing the debt. Well, that's great. But if debt's growing at over 10% a year, how often has it been that we have grown the GDP at greater than 10% per year on a sustained basis? never, because we wouldn't need that for 1 year. We would need it for decades to grow our way out.
Right.
So we did have it print for 1 or 2 years above that level, but it both times related to World War II. The one was all the industrial buildup of, they were building tanks and all these things prior to World War II, or while it was going on. And then coming out of World War II, it was just, the biggest economic expansion in our country's history. And so, even if we replicated the biggest economic expansion in the country's history, which now we're a much bigger country, so those are much bigger numbers, and harder to achieve, they only got 1 year of growth at that level. And so what's the probability that we're going to have decades at over 10%? Zero, near zero. And so, it's not going to solve the problem. Could it slow or give us a little bit more time to kick, or road to kick the can down? Yeah, it would help us kick the can a little bit longer. But what's kind of really concerning is both the current president, as well as the head of the Treasury, as well as the incoming potential replacement of the Fed head, they've all talked about a monetary reset needed in the country, and that Bessent himself has said how he wants to be participating in that himself. So within the next 2 to 3 years, under the current administration, they are planning for and want a monetary reset. And they referenced the Versailles Accord. They referenced a couple different historic times that had happened, and each time, what was the outcropping of that? And that was basically a major devaluation of the dollar.
Right.
Trump has been very open on his comments publicly. When the dollar was having the worst year-to-date performance in history over the last month or so, he was interviewed about, or he was asked about it, and on camera, and he said, "Oh, I'm not worried about it. The dollar's not weak." And so, we hadn't hit concern levels, and he's been very public that he wants a weaker dollar so that it can help our position with global trade, so we can bring manufacturing back, and our goods and services aren't so expensive for foreigners to buy. That's a multi-decade move. Yes, we do need to bring some manufacturing back. I agree with that, because COVID, I think, showed that we were in a very difficult, tenuous position, since China made most of our medical supplies and pharmaceuticals. And so, we had to get everything from them if they were willing to send it to us. And so that's not a good position to be in. And, China's been very advanced in their technology. And so, terrifyingly, we buy a lot of our input products that go into our high-tech weapons from China. It's absurd. And so, again, not a good position to be in, but very hard to turn that tide quickly. But at least they're focused on it. So,
Bruce, real quick, I have heard recently folks talking about using or mark to market the gold reserves that the United States has, which I thought was a really interesting strategy. For those who don't know, at least on the government's books, gold is valued at $42 an ounce. And if you're following gold, it's $5,000 an ounce, according to the market. I was doing a little bit of research myself over the past few days, and even mark to market, I'm not saying the strategy would even work, but if we were to do that, the valuation that our government has of gold on the books would only be a little bit north of $1 trillion compared to our $38 trillion of national debt and growing. So it's so hard to wrap our minds around how monstrous this dead animal is. But I thought that was interesting.
Yeah. And, I feel like it should be certainly more representative of the current value than where it is. But yeah, this is just a, financial magician kind of thing to do.
Correct.
Where you reset it to, there's no constraint to say they reset it to current values. They could reset it to 15,000 or something
Correct.
like that, and just radically debase the currency. But it would show on paper, accounting wise, that the government had all this additional money and allow them to put a lot of cash, because the Treasury would buy it from the Fed or vice versa. I can't remember which way it goes, but it increased their checking account, so to speak. But it's, again, like you said, I've seen estimates all over, because the gold has been all over the place. But let's call it $1 trillion. I know that's close, and that's not even a third of our deficit for this current year, right? So, and you have to remember, Trump just tweeted or said the other day, our defense spending is around $1 trillion. He said it needs to be 1.5 trillion. Well, $500 billion is a lot of money, and that has to come from someone.
Yeah, just incredible. I love that you bring up the you and I were talking about our national defense, and I think it's very sobering to see our annual expenses as a country, this was just fiscal year 2025. The interest on the national debt was our third largest expense.
Yep.
I know Sam said, tongue in cheek in the comments, oh, we can just kind of ignore this national debt. I think interest on this debt is going to continue to grow, and I don't know if
Yeah,
we're going to be able to ignore it much longer.
that's trailing 12, right? And
Mhm.
if you look at our current spending on debt and annualize it going forward, that's more like 1.2 already.
Mhm.
And we have 48 trillion in debt maturing over the next 4 years.
Yes.
So no, wait, or is it 48? Yeah,
So,
that's yeah.
yeah,
So
just
no, I think
good.
I think that's a little bit high. I think it's 28. I'm sorry. Yeah, so it's 28 trillion maturing in the next 4 years.
Mhm.
And so if you do some simple math on that, for divided by four, that's roughly 7 trillion, or six to 7 trillion, depending if you're using 24 or 28. But per year. Now it's not evenly spread like that, but so if we look at COVID and what happened inflation wise, how much did we print during COVID? Well, it was less than 4 trillion, and so if we bump that up to six and then do it 4 years in a row, what's going to happen? That's and the reason I say that's money printing is because again there aren't enough buyers for that, and all of those as your bullet point states, the current debt is at 0.5% to 1.5%, and it's going to reset at probably 4.5, 4 to 4.5, and so radically increasing your expense burn, interest expense burn. And I said there are some really smart analysts out there that call a real interest expense includes not just the debt service but also the entitlement payments that everybody knows they won't cut. And so if
Oh,
you
yeah.
if you look at those two things together, Social Security interest on the debt, et cetera, then we are already that amount is equal to almost 100% of the revenue collections by the Treasury, and so um, income taxes. And so that doesn't include defense. That doesn't include anything else. The
Right.
Department of Labor, or anything. And so just that amount is already 100% of what we collect, and that's not healthy and it's not sustainable.
So is Warsh coming to save us, Bruce? Is that is he our
Well,
savior?
I've read a lot about him, and he is a very smart guy as well, and so
Mhm.
that gives me optimism.
Mhm.
He, certainly more qualified than Janet Yellen was.
Mm.
That was just
All five
absurd.
foot two of her. That's what I like the best about
Yeah,
her. She was
some
short like
some of the
me,
things
but
she
yeah.
said were just terrifying. But interestingly, for those on, I don't know if they're familiar with this because they're not in the investing world, but there's a guy named Stanley Druckenmiller, and he is probably one of the best investors ever. He has
Mm.
averaged over 30% per year on his own accounts. He used to run a hedge fund with George Soros, um, but now only runs his own money, and he's a billionaire, obviously. But it doesn't take long to compound nicely when you're making that kind of money.
Yeah.
But both Kevin Warsh and Besant both worked for Druckenmiller at one point in time, and
Mm.
so um, you know they are very very smart people, or they wouldn't have had those roles. Kevin Warsh was actually involved when you may have heard the stories when Soros almost bankrupted the UK by trading the currency against it. He was heavily involved in that, so he knows what can happen with currencies very deeply. But when they announced that he was probably the pick, the markets plummeted, if you remember, because they thought, oh
Hmm.
gosh, this guy's a hawk. Hawk means that he's reticent to raise or to lower interest rates. And Druckenmiller actually came out publicly and said the market is misreading him. He's not a constant hawk. It depends on the scenario. So what
Right.
Warsh wants, he does want to cut interest rates to help fuel this growth that they're looking for, and he wants a deregulated environment and things like that because they need growth at all costs. And
Yes.
but he also wants to reduce the Fed balance sheet. Now, I don't know how you do that
Right.
when there's nobody to buy your debt, but good for him. That's great.
We love that for
I'm glad
you.
I'm
Yeah.
yeah, I'm glad I don't have either one of those jobs. I know that because it's really complicated. Um, but he's been what they call a supply sider, which means
Hmm.
they're promoting pro growth fiscal policies, simpler tax codes, deregulation, things like that, and against protectionism and those sorts of things. And so I think that they've talked about basically they called it an accord between the Fed and the Treasury, which means
Yes.
he sees an environment, as does Bessent, where they are working hand in hand to accomplish the goals that they want, and they both see a world where there is a monetary reset. So, um, I think that the market's got it wrong. I do think he's going to cut the federal funds rate. Now, does that mean that the Treasuries rate will go down? No, it doesn't. We saw that happen this year or this last year when the Fed started cutting. Treasury rates actually went up. Well, that's not something that they thought would happen because they thought they were all powerful and they could control rates. Well, in a market that size, they don't. The debt holders control what interest rate there is. Now, they can't affect it because if people say, you know what, you're cutting interest rates in a time when there's inflation, that's creates weakness for the dollar. Um, we're very concerned that you're not going to be able to repay the debt, so people start selling the debt, um, and that forces the price down, which forces the yields up. But what I think is going to have to happen is the Fed or the Fed and Treasury together, Bessent will have to step in and buy the longer dated Treasuries to help bid up the price and keep the interest rate lower. And so, but how they do that while shrinking their balance sheet, I have no idea.
Those definitely seem to contradict themselves. And one wonders if the Fed, I think Warsh has talked a little bit about creating maybe a little less transparency and doing a little bit more kind of signaling, if you will, than Powell did. Powell seems to be very straightforward. We say we're going to do this. This actually comes to fruition.
Yeah.
So I don't know if I read that right.
He wants to do away. Yeah, you did. He wants to do away with the dot plot, which a lot of Wall Street focuses on now.
Right.
It's kind of funny because the dot plot is one of the least accurate indicators of interest rates ever. But
yes,
people focus on it, and because it's an expression of where the Fed is saying they think things are going.
right.
He wants to eliminate that, and does want to do fewer interactions with the press and things like that. They just want to take action as opposed to postulating and trying to talk the market different directions. We saw a situation where the yields or interest rates have really been constant. In the last part of the year at least, but we saw a divergence between that and the dollar. The dollar is selling off in spite of rates not being cut. And so normally interest rates are supportive of the currency. And so, if you raise rates, it would usually mean your currency would increase in value. But, we're seeing a break from that. And that's just telling us that people are kind of losing faith in the dollar. This is not an overnight kind of thing. I mean, people are still going to use it for transactions for a very long time. It's just a matter, but it's not a store of value. And that's what people are kind of waking up to. There is counterparty risk. They're all aligned to say that they want a monetary reset. So, those are all potential negatives for the dollar. So we'll see. He's also of the mindset that AI is going to be very impactful from a growth perspective. I don't
Hopefully.
know. That's a really complicated subject. But you've probably seen the press. I mean, Anthropic and some of the rate at which it's learning, and the rate at which it's increasing its capabilities is just step functioning. Honestly, week by week almost. And I look at how we've used it, and earlier last year we were using it. Hey, we hired a new analyst, I think and
yes,
rebuilt some of our financial models and asked some of the AI, hey, how do I create a formula that does this? And then we give it to you. Now, just not even a year later, you just describe for it what you want the model to do, and it builds it for you, the whole thing, not just a formula. So, it's really rapid. How that plays out, they're going to be dramatic labor impacts, I think. And, how and where that hits, I don't think we fully know yet. But I mean, it just last week, I think, created a couple movies even, and I haven't seen them, but I've been told they're pretty good. And so now people are thinking, gosh, LA, it could be a nasty for LA, right? And you might get some, I don't know, but we'll see how it plays out. It's early, but on these kinds of things, you have to position for where you think it might go. Otherwise, it's kind of too late. So.
Well, and that leads us to the brilliant line that you use with many of your LinkedIn posts, which is position accordingly.
Position accordingly.
Yes, and we could listen to Elon Musk, who tells us universal high income is going to be all of our savior, Bruce. But that'd be nice. But I question kind of the economics of if everyone has a bunch of money, no one has a bunch of money. But anyway, I don't think
Yeah,
we're going to
that's
ban that. We're going to try to
well,
protect him
and the
from having
government
to.
won't have a lot of money because they'll lose a lot of taxpayer base, right? And so the money would for UBI would have to be printed, which is inflationary. That's the thing.
Yeah.
If my kid, if our kids both get, an allowance a month, let's say, and you give them that, but then you double it, well, you know what? They're going to be able to pay more for stuff, and they, push the prices up because if there are only three apples in the world and you've got five kids, well, somebody's going to pay more for it, right? And so that's just kind of how it works. But it is
Yeah.
very complicated, the AI impact, but I don't think we even know where all it's going to impact. But I do feel good about our investment thesis still. We talk about it daily, but we really focus on distress situation turnarounds. So create substantial equity pretty quickly, but also our tenant base, it's workforce. And so they're really laborers, people that are doing things with their hands. And people that make their income from interacting on a screen, we don't know, could impact them certainly with AI. And so but people that are laborers, yeah, 10, 20 years from now, it could be robots, sure. But I mean, I think shorter term, you know, I mean, they're not going to be replacing maintenance guys with robots anytime soon in our apartment complexes, or serving tables, waiters and waitresses and things like that with robots anytime soon. It could happen, but there's a cost barrier. Sure, a restaurant can't afford to go buy $250,000 robot to do something. So I feel
Right.
like relatively insulated, but the world could get crazy. I don't think I would want to be in A class stuff right now, because there are going to be so many white collar. We don't know which industry it'll necessarily come from, but there's certainly risk in finance and other areas. Um, and the people that are in the first 5 years of their career, let's say, that are working a, a brain job, those are people that usually go into those properties. And so I don't know how that's going to impact things.
I love that you bring that up. And for anyone that's watching that doesn't quite know the different classes of apartment complexes, Class A is generally some of the newer, and by input and by design, it tends to be the higher rent, maybe more white collar in general type apartment complexes. Class B is a bit more in the middle. Class C is that older vintage 1970s. Are we going up to 80s now for Class C, Bruce? I think there's yeah, maybe.
It could go either way. It
Yes.
depends on where it is, probably.
Yeah. But this classic workforce housing that Bruce and Elkhorn Capital focus on that does cater to the more blue collar folks that may be less impacted by things like this. I'd love to hear a bit more kind of about your thesis there, Bruce, if you don't mind wrapping up with that and kind of how that relates to the economic microeconomics that we discussed here.
Of C specifically, C class workforce, or just
Or just,
multifamily?
yeah, just how you're thinking through protecting and preserving your wealth. I mean, you've had great success, obviously, in investing in various asset classes. So why multifamily? Why the C class workforce housing specifically? How are you thinking through that?
Yeah, well, I was invested in real estate, as you know, prior to '08, on investment properties, and my partner and I sold everything in '07 that we had because of the research we did with the hedge fund. So we were very concerned about what was forthcoming. Fast forward, we formed Elkhorn in 2010 because looking at the financial crisis and what was going on, again, it's just math, but we knew the Fed was going to have to print a bunch of money, which would
Yeah.
create inflation. So we wanted to trade our fiat currency paper dollars for something real. And so, a lot of people call that hard assets. So what hard assets did we want? There are plenty of good options, timber property or oil and gas mineral rights, or
Mhm.
certainly multifamily or retail or office. I didn't like retail or office because um, it's too business cyclical. And so, if there was a recession, the Fed ever let that happen again, um, I didn't want to be exposed to movements that I couldn't control. And so I really honed in on multifamily. I like it a lot better than single family rentals. Some people do SFR portfolios, but uh, it's so hard to manage and so hard to influence the value. The difference between single and multi, if I was able to buy a single family home for $100,000, but I was able to collect somehow 15,000 a month, which is not possible, but let's say that could happen. It doesn't matter because at the end of the day, when I sell the property, it's going to trade based on single family comps in the area. And so it's going to trade as $100,000 house. And so if I buy a multifamily property, it's like buying and selling a business. You're trading on a P&L. And so if I can improve that P&L by either increasing revenue or decreasing expense, if I drop 100 extra grand in the bottom line, you know what, I probably created 1.5 million or more in value, depending on the cap rates in the market I'm in. And so you can force this value creation by being smart about how you invest your money and what amenities and what things that you do to the property. And so I liked the residential component of it because people always have to have a place to live. I liked C because it has historically been the most economically it's been least sensitive to economic cycles, because if you're in the nicest A property, let's say in uptown Dallas, for example, there's some beautiful properties there, but you know what? If times get hard or people are making less money, they don't have to have a Wolf stove. GE works just fine, and so they'll trade down. And you see, it's not bottom rung. You got government housing and maybe some D assets below it, but
Oh yeah.
yeah, it's where a lot of people work, and they need a clean, safe place to live, but they can't afford an A property. And so I liked that nature of it. People trade down during hard times. So guess what? We're C, and so they may move out of a B and say, I don't need to have a property that nice. I just need a safe place to live. So that's kind of how we got there and why. That's not to say some of the other options aren't good. Really, what you need is to have a good or service that you can trade for whatever the going concern is in the future, whether that's a lot more dollars because of inflation, whether it's grams of gold, whether it's yuan, whatever we're trading in 10 years from now. If I have oil and gas mineral rights and I get sucked out of the ground 10 years from now, I am protected from inflation because I can trade it for whatever the transaction currency is at the time. And the same thing goes with multifamily. We own a property, we have units. If inflation goes up, then we'll raise rents. Now a lot of people got this wrong. There are a lot of markets. I won't name markets because I don't know everywhere you own, Amy, but I think you're smart. And so you probably got it right. But there are markets where just doing the work on the quantitative side and looking at supply data, looking at population growth. And I know you're very public about, hey, I live in California, but I don't invest in California.
Yes.
And that's so well said. Yeah, I wouldn't touch buying a property in California because if I have a product and I can't force the people to pay me for it, that's a pretty terrible business. And the landlord laws on the coasts, not just California, but East Coast as well as some other places like Seattle and others, the rules are just so anti-landlord. I can't imagine why you would want to put money or capital to work in those markets because you can't evict a tenant if they don't pay you. Well, once they learn you can't evict them, guess what? They don't pay you, even if they have the money. And so it's nuts. And so we are very focused on kind of the South and Midwest. One of the things we look at are just business friendly environments, and we also look where the population's going. Oklahoma is not sexy, but you know what? It's a top 10 market for a recipient of population growth. People are moving to that market, and and Dallas is certainly higher on the list. But it's also an environment with so much capital chasing deals here. There's so much supply being built. Dallas isn't one of the ones that I would knock on for supply, but there's some very large markets in the country where I have friends that bought in all of them. And it was clear that they're building when all those new buildings come online, there's going to be pressure on rents because you want a brand new one instead of a 5 or 10 or 20-year-old one. But the other thing that a lot of people missed, and this is specific to another town in Texas, but the rents were so far above the median income or the national average that it just wasn't affordable. Austin was just recently listed as the market with the most rent reduction in the last year. And that's exactly why it's a combination of supply coming online because it's sexy to build there. It's easy to raise money to go build a development in Austin because everybody likes going there.
Right.
But my daughter lived there for a while, and I know firsthand. She's like, Dad, if they move me to the market rents they're posting, I'm gonna have to move. I can't afford it. And so it's literally not a decision. They're well over the national average of 30%. These deals that you just participated in with us recently, after we buy them, fix them, and raise rents, we're at 22 to 26% of the national of the median income in the I think 2 mile radius of those properties. Well, that's super affordable. And so even after we raise rents, people can afford to pay us. And so we look at things like that very closely. We look at unemployment rates, job trends. The supply of C properties in Tulsa is actually going down because some of them have aged out and they've been torn down.
Yep.
But there are a lot of manufacturing jobs coming in. That town is doing a lot of good things to attract companies there. Your land's cheap. Other good reasons. There's actually one of the furthest inland ports is just outside Tulsa, which blew my mind when I first read it. I'm like, a port? What are you talking about? But
Yeah.
it is. And so that creates a lot of opportunity as well. So a lot of good things happening, but we really dig into markets. We don't just pick a market because we got an OM from somebody, from a broker,
Right.
or we had a friend buy there. We want to know why we're there. And so I think a lot of people kind of didn't know why they were in the trade, so to speak.
Mm.
But I had some friends when I was at an offsite with a handful of operators, peers, that you mentioned LinkedIn, and I don't post often, but when I do, it's
Yes.
thoughtful about macro
Yeah.
and kind of what I see going on. But they followed me and they were saying, "Gosh, I thought you said this was a great inflation hedge." I said, "It is." So well, I'm getting hammered. I said, "Well, you did it wrong. You bought in a market where you don't have pricing power, and
Right.
you floated on your debt and your expenses. What we're trying to do, we're trying to lock in not just our fixed rate debt, which we had even before the rate hikes, because we knew why we were in the trade. We know rates should be higher than they are because of inflation, and so we were fixed on everything. But we also are looking at vendor contracting. We get 3 years on this instead of one, and fixing our costs and being on the right side of that. And so, and then we were in markets where, like I said, they're super affordable, where the tenant or the population can afford the rent increases. So that's kind of why we're doing what we do.
Powerful. I love that you mentioned all of the downsides that you are avoiding and not just the reasons for what you do. So I think
Trying
that's
to.
incredibly important.
And it's not always about saving money. Like, I look at our
Right.
payroll, and our average payroll is probably higher than some other
Mhm.
operators, but we pay market base, but we have incentive comps that if they're hitting their goals, we're making millions of dollars, and they make more than they could make anywhere else. But what a lot of property management companies do is they just squeeze those employees, and you end up with a very dissatisfied employee that could walk out any hour of the day because it's a tough job and go wait tables and make more. And so it's replaceable. And I think that the jobs with us are not replaceable for those people because they're probably making 50% more or even 100% more than they could make anywhere else. So they're
Right.
very motivated. And if we're have our payroll is high, we're thrilled because that means they hit their goals. And we've done very well for partners if so. So you have to be sometimes non-traditional about your thinking, and
Yeah.
focus on just the results that you're looking for, not necessarily fixating on cutting costs or something. And another thing we've done, we have a team of 5 people that are just float amongst our properties. um, that's a burden of cost that we took on, but it saved us a ton of money because now we don't have to third party or turnover on make readies or
Mm.
minor construction. The team just applies the hours that they work on that property that week, and they get paid by the different properties. But that, for example, washer dryer connection cut our costs in half. But it went from 1,300 to 650, and you know that that's a lot of money. And so you throw a cap rate on it.
Yes. That
But
multiplies.
there are other things I'm doing too. You see the screens behind me. I'm still very, very active in the public markets. Oversee close to $1 billion in the public markets. So quantitative strategies, not emotional. But my personal account, I'm positioning accordingly for my views of what I'm doing. And you don't have to have tons of capital or be worried about exposing it to some of these ideas. You can use options, and options scare people, but
Right.
you could put a lot less capital at risk if you use options for a bet and get the same payoff as if you had a large position. And so I use a lot of options, and you don't have to know everything about them. But there's a place called Option Industry Council, OIC. It's a great resource. It's just an investor resource, has lots of videos to teach you how to do different strategies, or even you can go there and say, this is, I'm bullish on this. I think this is going to go up. What strategy should I use? And it'll tell you, and has a video on how to do it and all of that.
Mm.
So that would be something I don't think we've talked about before, but something that would be good for investors to try to kind of get an extra bang for their buck
Yeah.
without going crazy. And, really what you probably would want was just long call options or buying calls on something that you think could move. We're talking about gold, maybe it's on gold, maybe it's on gold miners or something commodity related, something
Yeah.
like that.
I think this means I'm going to wrangle you into doing another webinar about another topic, Bruce. You are voluntold. Congratulations. No, I'm kidding. Um, no, this is really helpful.
Yeah, we're
Oh, go ahead. Sorry.
I was going to say, I've been talking to it about, I'm very open and transparent about what I'm doing with my own account and
Yes.
with the team. And So it's so funny because you know Matt well, but
Yeah.
I would say things and then I would get busy on the call with broker or something, and he would actually put the trade on, and I would forget, because I got busy. And he's like, "That was a great idea." I'm like, "Oh, damn it!" But this time, it was so clear to me. It was so that kind of what we've been talking about was happening, that I did position for it. And thankfully, I was on a podcast with someone, probably maybe a year and a half, 2 years ago, and they asked me what was one of the things that I regretted about my career. They're like, you've been obviously very successful, but what's something you regret? And there's some things I probably shouldn't say publicly because of different personnel or something like that. But
Oh,
I thought about it, and I said it's probably when I had incredibly high conviction, like in '08 or '07. I didn't position heavily enough for it. I'm not talking about taking an outsized position, but using calls or something like that, where if I'm right, this is going to be meaningful.
right.
I made money in a way personally in my account, but not as much as I should have. I
Mm,
did. I mean, I didn't know, no, but the math told me the S&P was going to go below 700, and we went to 666. And if I had pulled with it, in fact, I had another advisor that he had a bet with me. He's like, "There's no way." I'm like, "That's just the math. It's just if you take what the bottom PE normally is in a downtrend, and what the earnings are going to be, it's going to be sub 700." And so I stayed out of the way, made a little bit, but I should have bet better, bigger on it. And so this time around, when this is one of the highest conviction things that I had, I was like, you know what, I have more money now, and but I also had higher conviction. I was like, you know what, I'm gonna put a decent sized thing on, and I did, and it's been crazy.
that's great. That's great. We've
Because
got a
one of the
couple.
other ways that,
Go ahead.
let's say, just one quick thing, one of
Yeah.
the other ways that you can beat inflation is just to make a higher return than the inflation rate. It doesn't have to be hard assets, but if you can make a rate that's higher than the inflation rate, which is hard for people to do, especially if it's upper single digit inflation. But that is another way to protect yourself.
I like
What,
that
what
because
were you
the
saying?
conventional wisdom is really hard assets only, right? So I like that nuance that you talk
Mhm.
to of, that's really the threshold. If you're making a higher return than inflation, regardless of the asset class, then you're ahead of the game.
Yeah, you have to adjust for taxes too, but yeah. So,
Well, yeah, there's that too. Always taxes. Uh,
especially in California.
don't remind me. Folks, if you've got questions, says Bruce in Texas. Bruce is beating me there. Folks, if you've got questions, we've got Bruce here for just a couple more minutes. Obviously, you can see the depth and breadth of his knowledge, both in macroeconomics, but of course in investing specifically in several asset classes. Looks like Sam, thanks for your question, Sam. He'd love for you to speak about potential macroeconomic impacts of population reduction on rents and multifamily investing.
Of population reduction. Um, hmm, Hopefully he doesn't know about a nuke that's going to go off or something. But yeah, it's interesting because that's a longer term trend. I
Mhm.
think that the birth rates have declined over the years for sure.
Yeah.
And there were articles out the last couple of weeks just about Gen Z, I think it is, just the well, I don't know how to say it real cleanly, but they just are not having sex as much as older generations
Yeah.
did. And
Yeah.
so, that would obviously result in a lower rate of birth, an increasingly lower birth rate. So that is something that's kind of a multi-decade thing out there.
Mm.
Um, but I think that trend would have to be more rapid to
Mhm.
be offset, or to more than offset the inflation impact. And so I think the inflation impact is stronger. Um, but it is a fair point. Certainly we're seeing that in, even without, you can see population reduction impact from population migration as well. And so, we're
Mm.
seeing people move out of California, moving out of some other markets and into Texas, into Florida, things like that. And so those markets certainly have been impacted by that. I get emails from brokers trying to sell stuff in San Francisco. I'm like, I've never once expressed interest in buying in California. So I know they're really trying to throw their net widely because of that impact that you bring up.
Just to stack on that, because that's a really good point. Sam, the other thing too that I love to remind investors is there is no one United States real estate market. So although there may be trends on a countrywide basis, and it's very worth, it's very much worth paying attention to, there still may be areas like Tulsa or Oklahoma City that are growing tremendously. So that's why we are so hyper focused on market research.
Yeah. Yeah. It's really, really important. And I had a lender that had not loaned in Tulsa before, that when we bought one of our assets, they asked me, he came down, he wanted to check all the stuff, all of our assumptions, and really check the rents, because we found a property at the time that their rents were more than 20% below our C assets in C minus neighborhoods. And this was a B asset in an A neighborhood. And their rents were lower than ours for the same size. And he's like, that's not possible. And so we showed him our assets, showed us stuff in the area. And it was, a 30-year plus owner, and they were just kind of asleep at the wheel. But, we had breakfast one morning, and he said, why do you like Tulsa? And I start listing all the quantitative reasons. Like, these are all the reasons. And I said, I would never invest in this market, this market, this market for the same reasons. And he kind of smiled. I said, what? He said, we have deals that are going badly in all of those markets and the way that you just named. It's like, yeah, that's just because people aren't doing the work. Yeah. So there are always good markets. I think it just depends, like Sam said, where's the population going, where are the jobs being created? And that's going to put wind in your sails.
Yeah. Really astute question, Sam. Thank you. Anyone else here? Well, while we're waiting, I'm going to put Bruce's information in the chat. elkhornpartners.com. Hopefully I got that website right. I'm pretty sure I did, right, Bruce? And we also,
that's right.
Yeah. And then we also put your LinkedIn earlier. You all will get a recording of this webinar as well with all the contact information. I'm with investwithamy.com. We really appreciate you all joining us here today. There is so much going on. I have a feeling I'll be able to wrangle Bruce in for maybe a mid-year macroeconomic review as the Fed chair is confirmed, and we maybe see some movement in some ways come May or June, but we'll see.
It's going to be interesting. We know that. But,
it is.
We'll be thinking about it and trying to game it correctly. But yeah, I would encourage. You said you shared the link, but I would encourage the people watching this to do connect with me on LinkedIn. And like I said, I'm not spamming people with, hey, this is what I had for breakfast, or this is, picture of me wherever. It's probably one every couple months or something, but it's usually something that's a major topic on my mind. And I'm trying to really cull it down to simplify it for people, to translate it to what that could mean investing. And so I've gotten a lot of great feedback on the posts, and
yes,
so I'd encourage you to reach out.
Yes, yes. Todd would like to know, where can I find more trusted information on monetary reset?
Yeah, so I would Google Moran. He's one of the guys that Fed added to the Treasury Board. Mm-hmm. He wrote something called the Mar-a-Lago Accord.
Okay.
And it's available online. I don't have the link. I can try to find it, Amy, and send it to you. But it's exactly the game plan of what he is thinking. And he was the first person. He's the first person that Trump put on the Fed board. So that kind of tells me their thinking is aligned. Trump doesn't usually respond well to people his thinking is not aligned with. So
right.
I think it's fair to assume he's bought in on that idea.
Yeah. Yeah. Yeah, perfect. If you're able to, we can pass that on to you, Todd. That's a really good question. Thank you.
Yeah, it is.
Well, Bruce, thank you again. So grateful. I know you are a busy man in more ways than one, and taking the time to share your knowledge and help us plan accordingly is so valuable. So thank you again for joining.
Happy to do so. And that's why I do it. I don't want to be the one guy at the table that has a stack of coins in front of me and everybody else is struggling, when they're like, why didn't you tell me this was going to happen? That's what I'm doing. I'm trying to tell you what's happening, or what I believe is going to happen, so you can position for it.
Appreciate that abundance mindset.
Glad to be here. Thanks, Amy.
Thanks, everyone. We will see you again soon.